Hey all, today I'm going to be talking about negative interest rates and how exactly it is that they work. I'll also be covering whether this means that you'll actually be getting paid money to take out a loan. Oh, how I wish. But also what kind of impact this will have on your savings rates and the wider economy as well. If you enjoy this video or it helps educate you on what negative interest rates actually are, then be sure to drop a like down below and subscribe to the channel if you haven't already. Now let's get into the video. So let's start off with a little bit of background. All countries actually have a base rate of interest, which is usually set by the central bank of that country. So for example, in the US, the Fed sets the base interest rate, and that's currently set at 0.25%, which was obviously changed on the 15th of March 2020 as a result of the crisis. And over here in the UK, it's the Bank of England that sets the base rate. And here this is currently set at 0.1%, and that was changed on the 19th of March, also in response to the crisis. And this is the rate at which the central bank charges the banks, or banks charge other banks, to borrow money. So in the banking system, it's required that each bank hold a minimum level of capital each and every day. And therefore, if a bank is a little bit low on that capital, or if someone requests an absolutely giant loan that they currently don't have the cash for, they could borrow some money from a different bank that has excess money and obviously just pay a little bit of interest on that money at the base rate. The banks also use this rate as a bit of a guidance to charge their external borrowers or their customers, and also what they pay to people on their savings. So for example, say if you wanted to take out a loan with a bank, you'd probably get charged a rate that's an amount above the base rate. So for example, 3% plus base rate. And also if you're saving with them, you might have a savings rate plus base rate, like 1% plus base rate or 0.5% plus base rate. The central bank then moves this base rate up and down to spur on investment and to curb inflation when necessary. So what usually happens is that if a country or the world goes into a recession, the central bank of that country will cut the interest rates, because then it makes it cheaper to borrow and obviously easier for businesses to invest. And that helps the economy recover. And then obviously the central bank will then increase the rates to obviously curb the inflation. Because obviously if an economy grows too quickly, everything becomes more expensive and inflation starts to compile faster and faster. But obviously if the rates are increased too fast, when the country or the world hasn't had enough time to recover, it could have the opposite effect and plunge that country or the world straight back into a recession. So if we relate this to 2008, obviously during the financial crisis, the interest rates were cut and then the economy started to recover. But in 2011, 2012, there was another rocky patch, so rates weren't increased that quickly. And then obviously Brexit and the trade wars around the world happened, so the rates still weren't increased enough. And obviously now that the crisis has come along, rates have had to be cut again. And there's not much further that rates can be cut before we end up in negative interest rates. So how exactly does cutting interest rates spur on investment? And obviously during recessionary times, people tend to keep hold of their money and don't like to spend, which is obviously fairly reasonable. But that doesn't obviously grow the economy. And actually, it has the opposite effect in the sense that the economy could start to shrink and go into a deflationary spiral. Because obviously people aren't spending, that means businesses aren't making as much profit, which means they're going to have to cut back on employees and there's going to be a lot of job losses and unemployment, which just causes further fears and adds to the problem. So then as a result, the rates get cut. But what happens if that doesn't spur on investment enough? Well, they're going to have to cut rates further or even cut rates negative to spur on that investment to stimulate the economy to grow. And this is why we could soon end up like Japan with a negative 0.1% interest rate, or like Denmark with a negative 0.6% interest rate. And this is really interesting because these countries have only fairly recently cut their interest rates, and obviously this has never really happened before in history. So what exactly does negative interest mean? And at first glance it sounds really kind of crazy, because you could be getting paid money to take out a big loan to go and buy a crazy expensive car, and you'd actually be earning money each month to buy a car. God, that sounds pretty nice. And so when the central bank cuts interest rates to negative, it means they actually charge other banks to store money with them. So instead of them paying the banks some money in the form of interest, the banks actually have to pay them to store their money. And so the reason why this works, and the reason why the other banks pay the central bank to store their money, is because where else are they going to store it? They can't exactly withdraw it all and hide it under the bed or put it in their wallet. They have to store it somewhere. Now they could obviously store it in stocks or bonds or something like that, but obviously there's no guarantee that these stocks or bonds will stay flat or go up. they could go down and the bank would lose a lot of money. So therefore it might just be easier to pay a small fee to store their cash. And they can't exactly just go and lend their money to other banks, because again they'd have to pay for that privilege. And there'd be no point in receiving loans from other banks to gain the interest, because they'd have nowhere to store the money or nothing to do with all the excess cash building up. Therefore it obviously really encourages the banks to go out and lend to people like you and I to buy a car. And obviously they can just charge a few percentage points above the base rate so that they're still making a profit, but obviously charging you and I a lower interest rate. And therefore if the bank only charges you a small or a few percentage points above that negative base rate, that means that you and I are getting a fairly cheap loan. And obviously if we can get a cheap loan like that, we're fairly likely to go and spur on investment and to buy things like a new car or a house and different bits and pieces, which will help regain and regrow the economy, so that obviously the central bank can then put rates back up. But it does also have the effect of actually damaging that country's currency, because other banks from overseas or other people from overseas aren't going to want to invest in that country because they won't be earning any money. They'll have to pay money to store their money there. But devaluing the currency does actually make exports more interesting and more appetizing, because obviously that country's exports are going to be cheaper, which kind of helps grow the economy from the inside, because that country is then going to be exporting more things externally to different countries. So obviously more money is going to be flowing into the country from overseas, not just money moving around that same country. If you're enjoying the video so far, then be sure to let me know down in the comments below what you think about negative interest rates, and whether you think that negative interest rates could help spur on investment and help the economy during these tough times. But how do negative interest rates actually affect you and I? And I suppose it really depends on how much the Bank of England or the Fed cut interest rates negative. For example, if rates are only cut negative to 0.1% or 0.25%, it probably won't affect us that much. And that's because the banks tend to charge you and I an amount above the base rate for loans or to pay us on our savings. So before the 19th of March, when the interest rates were cut to 0.1%, the base rate was 0.75%. But if you wanted to get a car loan, you probably wouldn't be getting that at 0.75%. It'd probably be somewhere between 4 and 8%. So therefore the banks are charging you like 3 and a bit to 7 and a bit % above the base rate. So if the base rate was cut to negative 0.25%, your car loans would still be at between 3 and 7%. So unfortunately at this level, you won't be getting paid money to take out a car loan. It would just make your car loan slightly cheaper. But if the interest rates did get cut to something like negative 4%, you really would be getting paid money each month to take out a car loan, which would massively incentivize people to go and take out as many loans as possible and take out the biggest loans, because obviously they'd be getting paid money every month to have that loan and go and buy something new like a new car or a new house, which would massively spur on investment and obviously help the country or the central bank increase those rates back up faster as the economy recovers. But it could be really hard to control, because if rates are cut negative too little, like only a bit negative, it might not spur on the investment necessary. But if rates are cut negative too much, and something like negative 4 or negative 5 or negative 10%, it could get really out of hand, because people would be scrambling over each other trying to take out as many loans and as bigger loans as possible to buy anything in sight, which would help the economy recover really quickly, but it could get massively out of hand and then inflation would just spiral out of control. And if you've made it this far into the video, be sure to subscribe to the channel, because I make new videos just like these on investing 3 times a week. So what is the likelihood of negative rates actually happening? And for this part, I think you have to remember that banks aren't really your friends. They're not going to want to lend you loads and loads of money, and they're not going to want to pay you for you to take that money from them so that you can get paid to go and buy a new house or a new car. Therefore, if interest rates do get cut negative, they're likely to only be cut very slightly negative, like negative 0.1 or 0.2%. And also the banks are probably going to start introducing different ways of making money as well, such as increasing setup costs or early repayment charges. But alternatively, the banks do want to help improve the economy, because more money in the economy will mean more money stored in the banks and more money to lend to people to make a profit on and more money to charge fees on. Because a lot of the time it boils down to just how much money the bank is going to be making, kind of like their bottom line profit level. If they can do anything to increase that profit, they're more than likely to try and do it. So that does mean doing anything they can to avoid deflation, because in periods of deflation, people hold on to their money and they don't like to spend it, and they don't like to take out risky loans, so the bank will be making a lot less money. So obviously they want to try and avoid deflation and help the economy recover more so that they can give out more loans and make more money. So there is definitely a chance that interest rates could be cut negative, but it's unlikely that they would be cut negative enough to impact you and I to the point that we're getting paid money to take out a loan. It's likely that they'd just be cut to something like negative 0.1 or 0.2% to incentivise the banks to lend more money to you and I instead of having to pay money to store it at the central bank. They can obviously lend the money out and generate a profit that way instead of getting paid a small amount of interest each month. And it's unlikely that people like you and I will have to pay money to store our money at banks, because this would cause a massive wave of withdrawals and money flowing out of the banks for people to either hold their money just in cash under their bed or to invest it in an overseas bank. But they might charge people that do have significant amounts of money, such as say Samuel Leeds with 16 million, to store his money, because he can't exactly take it all out and store it under his bed. Therefore, if interest rates were cut negative, it's likely to only affect the central bank and other banks and other big institutions that invest in things like gilts, such as pension schemes. And as always guys, if you want to learn more about investing, then be sure to watch some of my other videos. Alternatively, subscribe to the channel and ding the notification bell. This way, you'll be alerted when I upload a new video. Cheers!